Good morning and welcome back to Market Monday after our Thanksgiving week hiatus. We hope you enjoyed a nice Thanksgiving and are getting ready for the holiday season. Well, it seems that it is the tale of two cities. On one hand, still solid employment and GDP figures. Important to remind ourselves, these are lagging economic indicators. Decent retail sales reports and by many measures, record-breaking Black Friday and Cyber Monday sales days. But with so many other stormy economic clouds on the horizon, inverted yield curve, cooling housing market, slowing earnings growth, a hawkish Fed, we're wondering if the anticipation is the worst part. Speaking of the Fed, this cartoon sums up the sentiment of many investors. The Fed is laser focused on a lagging indicator, inflation, in the rearview mirror here, and using a tool, raising rates, which often has a long and variable lag into the future, to tame the lagging data. Meanwhile, the Fed's rhetoric has been unmistakably hawkish, a tone we don't expect to change at its upcoming mid-December meeting. This dynamic has many investors, including some well-known public figures, to call for the Fed to stop hiking and actually begin cutting immediately. So here we are again with a Catch-22, where inflation is slowing, but perhaps not fast enough, which will keep the Fed hawkish, which may lead to over-tightening and tipping us into a recession, which would likely lead to Fed rate cuts. Without that type of economic destruction, it seems unlikely moderating inflation would be enough to cause the Fed to cut rates. So more pain early next year could pave the way for some relief later in the year. But less pain near term likely results in a tighter for longer Fed policy. At this time, getting the best of both worlds does not seem to be in the cards. One interesting point that we expect will get more attention in the next year is the sheer interest the government is paying on its debt, especially as the government budgets and potential shutdowns come back into play. They will come back into play. Government outlays on net interest expense have surged over the last year. All of that additional risk-free income folks are receiving, even some of you watching this video, has to come from somewhere, and that's a direct impact on the federal budget. Another point of tension in the market is related to valuations and earnings amidst the current sell-off. See, when inflation and rates started screaming higher, that caused a repricing of the stock market valuations. Investors were willing to pay less for earnings than they did in the years past. But companies still were and still are producing solid earnings numbers. So the question is, given that the sell-off has brought valuations down closer in line with historical averages, will earnings hold up, resulting in a fairly valued stock market? Or will earnings deteriorate along with the economy next year, likely resulting in lower stock market prices? The way it stands right now, current consensus estimates for 2023 S&P 500 earnings is for growth of nearly 5%. If that doesn't pan out, downside risks in the stock market appear more likely. Unfortunately, today's video isn't the most optimistic message, but our duty to you is to give you straight and not sugar-coated things during challenging times. We are not selling a newsletter, and we don't want clicks. We want to cut through all the noise there and deliver solid information to you. With that, we hope you enjoyed this week's video, and we look forward to being back with you throughout the holiday season. Have a great week.